And I would just say this, given this show is going to talk about Bitcoin, everybody, regardless of age, everybody needs a portion of their portfolio allocated to Bitcoin. The wrong answer is 0. The right answer depends on your age. It depends on your risk tolerance. It depends on your financial savvy. You learn about Bitcoin because it is going to change the world, and get an allocation to Bitcoin for your kids. Whether it's for you or not, I don't really give a shit, because you have already taken so much away from the future of our children. You actually deserve, or you have to give something back, you fat, old, lazy boomers like me. Not going to call anyone else, but I'm the fat, old, lazy boomer that has stolen from the future of our children because no one shouted out the fiat Ponzi.
Well,
so I'm shouting out the fiat Ponzi. They're givers and takers in this world, right? And I often say, there's probably in the world, and I'm an optimist, I'd say there's 60% givers and 40% takers, but it's probably, that can flip either way. The good thing about the Bitcoin community is we're 85% givers and 15% takers, is just my own, approximation. And then on Wall Street and Bay Street in Canada, 99% takers and 1% givers, okay? So perhaps the guy I'm calling out most are the fuck-ups that work on Wall Street, like I did, that know that they are takers at the expense of most everybody else in the world, and they don't give a flying how are you, because that's what Wall Street is. Why do you think most criminals go and work on Wall Street? Why? Because it's the easiest place to steal from someone and not break the law. Okay, that is exactly that's the generation I'm talking to, Josh, not your solid citizens who are paramedics and firefighters and first responders. I'm talking to the lazy fucking Ivy League cucks, okay, who go to work on Wall Street and get granted and think that they are somehow, they have entitlements to this type of lifestyle. Many retirees are concentrating on bonds. And that's fine when interest rates have gone for 40 years in one direction, which is from the top left down to the bottom right, interest rates, which means bond prices have gone the other way, and your returns have been very attractive. In 40 years ago, you bought bonds with a 20% yield. I mean, that's true. Now these bonds yield in the 10-year under 4%, the US 10-year Treasury. So it's a markedly different environment for the older approaching retirement person. Here's one of the investing guidelines that I think is going the way of the horse and buggy, where they say take your age, and that's how much exposure in a balanced portfolio you should have to fixed income or bonds, right? If you're 70 years old, you should have 70% bonds, 30% equities. Well, that is a absolute formula for disaster, in my opinion, especially since bonds now have asymmetric downside in return. And as you guys correctly point out, it's a fiat contract that debases. Like, you have a certain amount in there that's supposed to keep account of inflation or compensate you for inflation, but doesn't compensate you for fiat debasement. And that is the problem. So bonds are part of the fiat Ponzi.
When you think of it as digital gold, then it should replace gold. Gold's worth $10 trillion, and that takes Bitcoin to 500,000. But when you think of it as digital property, like replacing buildings and land and other long storeholds of wealth, then, you're up by a factor of 20 or 30 from there. I mean, it should not be... It's much better than digital gold because I can move Bitcoin at the speed of light, and I can program it to 1 million transactions an hour on an iPhone or a website. You can't do that with gold. So it's got more utility than gold, which means it's probably worth 20 or 30 trillion if it just replaces the gold.
I happen to pull out a genie in a bottle, and the genie comes out and says, well, Michael, I'll give you infinite wishes. Let's start with real estate, real property, and strip every defect away from it. I say to the genie, I like the way you fixed my property and made it maintenance-free and indestructible and immortal, and allow me to program on a computer and move at the speed of light and make it non-confiscatable. But now I'd like you to guarantee me that you don't sell more than 21 million blocks of this in the universe forever. If you actually could get the universe to agree that there'll never be more than 21 million blocks of perfect property, that's the icing on the cake, right? When I did everything else, I created digital property, but when I capped it at 21 million blocks, I made it digital scarcity, or the ultimate scarce property.
Good afternoon, it's John Ford. I just want to clarify, did you say a $2,000 per share price target? Tesla right now is under 200 a share. So even if you were to 10x that, that would be an over $5 trillion market cap. Is that what you're saying?
That is what we're saying. We think that the robo-taxi opportunity globally will deliver $8 to $10 trillion in revenue by 2030, and is one of the most important investment opportunities of our lifetimes.
Okay.
And I think one of the reasons for that is it is going to save lives. 80 to 90% of auto fatalities and auto accidents are caused by human error. And autonomous driving is going to take away the human error.
Talk about what the market is doing today, because it is monstrous. We're seeing some big moves in a lot of different areas. This is the S&P daily chart. Look at that red candle right there. Huge down day on the S&P. Now we're going to talk about why this is happening. I just want to show you the intraday. It's been consistent. This is the 10-minute chart. You can see the selling pressure, and again, look at down here, consistent selling going on. Now, what's the kicker here? Basically, the answer is this, FRC, all right? This is First Republic Bank. Look at the drop today. It was already hammered on the banking crisis, essentially down about 42.5% today. Why was it down? Well, number one, they basically told us yesterday in their conference call that they lost 40% of all deposits. That was a worse number than expected. But to me, the biggest negative was that they didn't take any questions. Their conference call lasted for 12 minutes and it was done. They said no questions from anyone, we're done. That is not confidence building for the market, folks. In fact, if I was JPM, Goldman Sachs, a bunch of these banks put $30 billion into that, I would have said, you get on there and you answer every freaking question. Because again, the implications of them not answering questions and the drop in the stock price, that's far reaching. That's not just about that stock, it's about the banking sector and how it looks to the whole sector. All right, so now I want to show you this. This is your intraday 10-minute chart of Bitcoin. Look at that pop here. So what you're seeing here, and this is a 10-minute chart, so it's not a huge move on Bitcoin, but what we are seeing here is that people now are saying, oh, wait a minute, maybe there's a little banking crisis again. Maybe the answer is to buy Bitcoin. We'll see if it lasts. I'm not convinced of that. So again, don't get too excited here. But nonetheless, I do want to show you how that movement is going, which is again telling you that money is coming away from the banks, away from the stock market, and finding a home in Bitcoin. All right, next up, we got to talk about NVIDIA. I've been talking about this one as a short selling opportunity here at these valuations levels. Look at this pivot to this pivot and look at where you are right now. You're borderline breaking. We know that today after the bell, you have Google earnings and Microsoft earnings. So essentially, you're going to either break or not break. This is a hugely pivotal level. Let's take a look at Microsoft here going into earnings. The stock is selling off. It's off of its recent highs on the daily chart. But the bottom line is, guys, after the bell today, those two earnings will set the table. Now, what I was just saying before was that if these two companies don't report good results and you have the issues with the banks right now, you could be setting up for a very big down move in the markets. And the last thing I'll say, I've been saying this a lot, I'm saying be careful. The second half of this year is going to be nasty.
For people that think the S&P is just going up forever, if you actually denominate it in gold, the chart doesn't look that great, right? It had a boom in 2001, but it's not been good ever since.
If you simply divide it by the monetary supply, like if the monetary supply is going up by 7% and the S&P is going up by 8%, then the overall market's flat. And that makes sense, because why do people think that stocks should always go up 8%? I'm in business, Robert. It's hideously competitive. like do you think that we don't have a competitive market for everything in this country? It's obscenely competitive. And so what you've got, if you look at the NASDAQ, is you have like 5 companies, Apple, Amazon, Facebook, Google, right? Microsoft, right?
Yeah.
Those 5, and aren't they responsible for like 80% of the gain? Everybody else is competing, and it's a competitive market. And what does that mean? It means it's hard to grow 20% a year, because whenever you do anything, someone else is copying you and they're pushing on you. So unless you get a dominant digital network with a near monopoly, with these massive exploding economies of scale on a zero variable cost, low variable cost, it's very, very difficult to perform. And most of the S&P isn't, right? To the extent that the S&P isn't Apple, Amazon, Facebook, Google, Microsoft, they're just a bunch of companies competing with each other. So you would think that they would grow at the productivity growth rate of the overall economy. But of course, which is what, 2%, 3%? Why shouldn't it? If you had hard money, and by the way, coming back to that theory of Bitcoin network value, Bitcoin network value goes through the roof, skyrockets in the early days when there's massive adoption and massive technology explosion. But in the later stages of the S curve, when it's fully diffused and when it's mature, it just grows with the GDP. It grows with productivity of the people in the network. If they grow 2% a year, it grows 2% a year. Mm-hmm. So in a mature equity market, you would expect equity indexes, equity prices to grow with the GDP. If they're growing faster, it's the monetary expansion, right? Expand the monetary supply 7%, expand the GDP 1%, S&P should go up 8%. It's going to be disproportionate. The big tech, the leading edge, innovative tech is going to be going double, triple, quadruple that. And then the trailing edge laggards are going to be tanking. And then everyone that's working their asses off as hard as they can is going to be barely keeping up.
Right.
Because you have to do 100,000 things right just to stay in business in a real Darwinian capitalist economy. Mm. It's like being flat means defeating 99% of the rest of the market, being flat. To be up, you have to, Amazon's up because they beat 15,000 companies. Right. The next 2 are just slightly okay, and there's some that are flat, and everybody else gets destroyed because of the natural effect there.
You'll note for those of you who've never seen me do technical analysis before, you'll notice there's nothing on the chart.
Yeah.
Right. You'll notice there's no lines, there's no Fibonacci series. And by the way, I know all this stuff. Bollinger Bands, Fibonacci series, Hydromotion clouds. I've done it all, and I consider all of it. Well, it's nice if you like it, but it's not necessary. I was taught by a quantitative trader after years of failing with all the kind of classic technical analysis tools of being able to predict anything. And we wrote a book together. I've been using this system ever since. It works amazingly well because at some point you can just quantify what your pot odds are based on where you are in with a couple of very simple rules. The first thing to do is strip all extraneous information off of your chart so you have a nice, clean, simple, elegant desktop. It's like Jordan Peterson's first rule for life, right? Clean your room, right? And the same thing is here. Is that too much information is actually not a good thing. It actually winds up being its own form of confirmation bias. And the process is called reification. And look it up on Wikipedia, and you'll understand exactly what I'm talking about, which is that we are pattern recognition monkeys.
Yep.
Like we're really good at pattern recognition. And that's what our left brain does in order to assess threats and all the rest of it. But this is a philosophical rant before we get into what's going on. And it's important to understand that when you draw lines on charts, you create like pictures and models, and is this a cup and handle, or is it a falling wedge, or is it this, or is that? All of that stuff is actually just your brain going crazy. You're going, oh, I found a pattern. But does that pattern mean anything? Mm. And the problem with it is that it becomes its own self-reinforcing kind of tautology. Okay, and it's the process of imputing Reification is the process of imputing meaning into a pattern that you recognize that has no necessarily correlation or causality. With that said, I just look at the bars. I just look at the relationship to the bars, and I look at the relationship to the candles, and I let them tell me the story. So where we are right here, now this is Bitcoin index. We've had a really nice rally off of 16,000 down in here, where we had this unnaturally, disturbingly low volatility period for about 2 months, and then we had a breakout, and then that established an uptrend. There was a reversal signal here, which is defined by after a directional move, we had a move against it, and you check, and the check for this is very simple. You just check the close versus the last, well, in this case, low, because it's an uptrend of that trend. So we have an uptrend here. You check for a close below the last low in the uptrend within 2 bars. So it happened within 1 bar. So this is a 1 bar reversal signal. 1 bar reversals are very powerful. They tend to continue the trend, that the reversal of the trend, like 85% of the time. This has been back tested, going back looking at everything 50 years. 2 bar reversals are about 65%. So this is your tradable, quantifiable edge. But then look at what happened here. We barely broke the low. Yeah, just barely broke the low from the previous week, engulfing the previous week, and then going higher, breaking both the previous high and the previous low. This is a reversal signal. So what we have here is kind of back-to-back reversals. Why is that important? Because the last reversal signal is the one that's dominant, because this one's been negated. So this reversal signal it negates this uptrend, and then this reversal signal negates this reversal signal, meaning it continues the uptrend. And then we get this. And as I said before, 1 bar reversals tend to continue 85% of the time. 2 bar reversals about 65% of the time. And 3 bar reversals, it takes 3 bars to close below the low that you're looking at. Well, they're coin flips. So they confer no net advantage to you in a trading sense. 50% of the time they could go up, 50% of the time they could go down, right? They could continue the trend, or they could reverse the trend. And look what happened here. And the reason for that is because it takes a lot of energy in terms of investor sentiment to push the price down below this low. Like, these highs and these lows are emotional highs and lows of the market. That's why highs and lows are important. Okay. In Bitcoin, closes are arbitrary because it trades 24/7. They're more significant in markets like the Dow, which closes on Friday and doesn't reopen until Monday, right? And there's a 72-hour period where people have to live with their positions, and the world could change against them. But in Bitcoin, closes are kind of arbitrary, just to kind of close out a time period. So this reversal, or this 3 bar downtrend, is a weak downtrend. So it's not surprising that it gets reversed immediately, because here we are, 3 bar downtrend closing above the high of this downtrend is a reversal, and then we're off to the races. But now look where we are today. And all that was to tell you, oh, look, this uptrend in Bitcoin, which has been structurally kind of nice, has been, tenuous at times. We had a reversal here, we had a 3 bar downtrend here, and then here we are at the end of a 3-stage rally. And generally speaking, the 3rd stage of a rally is usually the weakest, because again, bulls are getting less and less committed as they go up, because, hey, we've moved off of 16,000, now we're at 30. A lot of people just got into this for the trend move. You're going to lose the momentum traders. You're going to lose the swing traders. You're going to lose the day traders, right? And only the long-term hodlers are going to be in here. And once that happens, the supply of sellers overwhelms the supply of buyers, and the price reverses. And so now that you understand the basics of market psychology, now you understand why you don't need Bollinger Bands. Now you understand why you don't need Ichimoku clouds or anything else. You understand this is the high. This is where a high is where the supply of sellers overwhelms the supply of buyers, and a low is where the supply of buyers overwhelms the supply of sellers. Is that supply strong enough to, one, first arrest the downtrend, and then is it strong enough to reverse it? And to reverse it, why it's important, why the high is important in this case, is because this is where the shorts would naturally set up, the contrarians would naturally set up, because that's the last time the market reversed, right? That's the last time the supply of buyers and sellers was out of balance. And so the shorts will naturally set up on a high, or the bulls will naturally set up on a previous low. And so when you break those, that's when you get broken field running, to use a football analogy, or you get the big directional moves. So what happened here, right? This tells you that there was no liquidity in the market, and the shorts set up here, and then they had to flip and go long in order to cover their ass, because they were in a wrong position, because the buying overwhelmed them quickly. And that's why we got this big bar. That's why we got this big bar. That's why we got this big bar. But in the reverse, the bulls were wrong, the bears were right, and we got a collapse. Okay. And, no argument that every once in a while, there are malign actors in the market pushing these markets to extremes, but that's also to your advantage as well. Okay. So market sentiment here, this isn't good for right now in Bitcoin. That's not to say that Bitcoin's going to re-enter a bear market and go back to 16,000. No, we've broken this low. This bar will close as of tonight at midnight, I think Greenwich Mean Time. And so if it closes here, then Bitcoin will have thrown a 1-bar weekly bearish reversal. Okay. And it means that this uptrend is likely to have been arrested. Now you start asking yourself, okay, well, where will it correct to? Well, that low is interesting. These lows are interesting. So here's 25. Oh, look, there's a couple of lows going all the way back to here, or highs here, right? Because they're going to go back to, where the bulls are going to go back to where they made money. They're going to look at the chart and they're going to horizontally look, oh, look, there's support there. Because a lot of people were interested in that price. So what is that, around 25.3? So that whole 25 to 25.3 area. If this close holds through today, I will not be surprised if Bitcoin corrects back into the 25s or even the high 24s. That would actually be very healthy after a big 90% gain here, almost 100, almost double, right? From 16 grand to about 31 grand. Like, you want to pull back and rebalance the market. It's healthy to allow the shorts to think that they're in control, because then you can beat their ass later. And that's the way you have to start thinking about this. This is all just a big bar fight between people who are bullish and bearish, right? And it's not and it has very little to do, to be honest with you, especially at the weekly level, very little to do with any kind of macro thesis that you can Bitcoin fixes this, or this is a safe haven trade, or blah. None of that shit matters. You got to go out to the monthly or quarterly chart to make that kind of conclusion, because you've got to aggregate more information about what longer term investors are thinking, because long term investors, hodlers, should only be looking at monthly and quarterly charts. They shouldn't even look at weekly charts.
If you found any value in this video, please hit the like and subscribe button below and click the notification bell if you want to be notified when my videos are released.